If silver is one global market, explain this. Western screens are celebrating 75, but Shanghai is whispering 78. Same metal, same planet, two prices. And here's the part that should make you sit up. Arbitrage is supposed to erase this. Arbitrage is the law of gravity in markets. If one place is higher, metal moves, the gap collapses, and everyone goes back to arguing about charts. So if Shanghai is still paying up and the gap refuses to close, that's not a bull market. That's a plumbing problem. Today, I'm going to show you step by step what Shanghai is actually pricing, how to convert it yourself, why this premium exists, and why the ARB is becoming impossible to close in time. Not with vibes, with a framework you can run every day, even if you don't trust me. 1, the first value drop. What does $78 in Shanghai mean? Let's kill the confusion. Shanghai has two silver signals people mix up. SHAG, the Shanghai Silver Benchmark. A benchmark. Price, a heavily watched silver contract in the daily report. The benchmark is published by the Shanghai Gold Exchange on its benchmark page. That number is not dollars. It's yuan per kilogram. And the exchange's rules spell that out. SHAG, quoted in yuan, kg, traded in lots corresponding to 15 kilograms with delivery on T+2. So when you see $78 in Shanghai, what someone usually did is take a Shanghai price in yuan, kg, convert it to USD, AUS, and then compare it to Western spot or COMEX pricing. And when you do that conversion on the latest Shanghai prints, you land around $76, $78, depending on which Shanghai series you use and what FX rate you apply that day. Now, let's actually do it together so nobody can accuse you of repeating internet rumors. So first big conclusion. Shanghai is genuinely pricing silver dollars above the West even after conversion. Now we ask the only question that matters. Why hasn't arbitrage crushed this gap, 555? What the West did today, and why that doesn't explain the gap. Here's the Western anchor. Reuters reports that spot silver hit $75 per ounce for the first time, reaching an intraday high of $75.14, trading around $74.46 early in the session. So yes, the West is also on fire. But a global rally explains why the West is high. It does not explain why Shanghai is higher still. If the market were frictionless, the gap would collapse because the trade is obvious. Buy cheaper silver in the West. Deliver, sell into Shanghai. Close the spread. That's arbitrage. And if arbitrage isn't working, that's the market confessing something ugly. The pipe is clogged. The arbitrage law, the simple version. Let's define the law of gravity clearly. If Shanghai is $77, $78, and the West is $74, $75, a normal system says, move metal east until prices converge. That's why cross-market price gaps usually don't last, because traders don't leave free money on the floor. So if the gap persists, it's not because nobody noticed it. It's because something makes the trade slow, expensive, risky, or impossible at scale. And in metals, the reasons are always some combination of time, logistics, paperwork, specs, ownership, financing, and the most important one, availability of movable bars. Today, we're going to walk through those frictions like a checklist, because this is where value lives. The real arbitrage equation. This is your tool. Arbitrage gap equals Shanghai USD divided by OSD, West USD divided by OST, total frictions, where total frictions include FX conversion plus hedging, funding costs while metal is in transit or tied up, freight plus insurance plus vaulting, compliance plus customs plus admin delay, taxes, fees, form constraints, refining, recasting time if needed. Most critically, can you actually source deliverable bars in size right now? If the friction stack is bigger than the spread, arbitrage is dead. If the friction stack is smaller, but time kills you, arbitrage is dead for now. If the friction stack is small and bars are available, the gap closes quickly. So the entire video reduces to one reality check. Is the friction stack now bigger than the spread, or is the pipeline constrained? Friction 1. Holidays remove the shock absorbers. This matters more than people admit. Holiday markets do two things at once. They reduce liquidity on screens. They slow the physical pipeline processing, logistics, approvals. Even on the Shanghai Gold Exchange daily report page, there's a remark explaining that trading day timing spans the prior evening session and the daytime session, and that the first trading day after a holiday only includes the daytime portion. Shanghai Gold Exchange. Translation: during holiday windows, normal flow gets weird. And weird flow allows price differences to persist longer than they should. But here's the key point. A holiday can widen the gap, yet it can't create a multi-dollar premium unless demand is already leaning on the pipe. Holidays expose weakness. They don't invent it. Friction 2. You can't ship a price. You don't ship an idea. You ship metal. Silver is heavy, bulky, and logistics sensitive. To close a Shanghai West gap, you need bars in the right form, available for export, insured, transported, cleared, accepted, settled. That takes time. And when time expands, funding costs and risk expand. So even if the spread looks like free money, it's only free if the clock cooperates. And in a stressed market, the clock never cooperates. Friction 3. Not all silver is deliverable silver. This is where people get fooled by totals. They look at inventory and assume it's a shared swimming pool. But inventory is layered. Some metal is already allocated to someone, encumbered, pledged, earmarked for industrial supply, sitting in the wrong form, sitting in the wrong jurisdiction, or trapped behind internal rules and delivery cycles. Shanghai's benchmark contract specs reinforce this idea. SHAG is tied to SGE recognized silver ingots, and it's structured around lots and delivery timelines. So when Shanghai bids up, it may be bidding on the right metal at the right place at the right time, not on abstract global silver. And that's why the Shanghai number can look like a different universe. It's not a different universe. It's a different layer of availability. Quick story. Human, not robot, the arb desk that tried. Picture an arbitrage desk on a thin holiday week. They see the spread, Shanghai, around $77, $78. West, around $74, $75. They smell blood. They call their metal contacts. Can you source size? The answer comes back. We can source, but not immediately. Or worse, we can source, but you'll pay a premium. Or the most terrifying answer, we can source, but delivery window is uncertain. And the moment delivery becomes uncertain, the arbitrage desk isn't an arb desk anymore. It becomes a risk desk because the trade is no longer about price. It's about whether you can perform. And that's the theme of this entire cycle. Silver is teaching markets the difference between priced and available. Our saying, friction, hash 4. FX is not a footnote right now. When you convert SHAG, AGT plus D, into dollars, FX matters. Around the 25th of December, 2025, USD, CNY is roughly in the low 7 range. Examples showed as 7.0059 around December 25. In a calm year, FX is a rounding error. In a stressed year, FX is another moving part you must hedge. And hedging has a cost. Add that to your friction stack. Because even if you win the spread, you can lose on the currency leg. So the ARB is not just metal logistics. It's metal plus currency plus timing. Friction, hash 5. Time costs money. And year end costs more. This is the silent killer. Let's say you can ship metal and you can hedge currency and you can clear paperwork. How long does it take? Days? Weeks? Every extra day is funding cost. Every extra day is risk. Every extra day is the chance the spread collapses before you monetize it. And year end is notorious for desks tightening limits, lenders tightening terms, risk managers demanding higher haircuts, reduced liquidity amplifying volatility. So an ARB that works in theory can be untradeable in practice. Now the core. Why this gap can be impossible in a stressed physical market. Let me say this in one clean line. A premium survives when the market is telling you the marginal ounce is not freely movable. Shanghai pricing in the high minus $70 seconds, while Western spot is mid minus $70 seconds, is the market saying the marginal ounce inside China is more valuable than the marginal ounce outside. Because the pipe to move that ounce is constrained. And because the buyers are not just speculators, they may be procurement driven. That's why this matters. It's not a number fetish. It's a signal about the system. Is this just hype? Skeptic section that builds trust. Let's be fair. There are reasons this could compress. Logistics normalize when holidays end. More metal flows into the right places. Paper spreads tighten. Local demand cools. And yes, if the gap was only created by thin holiday trading, it can snap shut. But we're not dealing with a sleepy silver market. Reuters is explicitly describing silver being driven by robust industrial and investment demand and tightening inventories as it hits $75. That context matters. Because in a tight market, gaps don't behave politely. They behave like stress fractures. They widen, they shrink, they widen again. And the trend is what you watch. Not one print, the 5-signal checklist, your value toolkit. If you want a real edge, stop chasing headlines and run a checklist. Here are the 5 signals that tell you the Shanghai premium is physical leaning, not just noise. Persistence. Is the premium still there after the holiday window? Benchmark strength. Does SHAG stay elevated on the SGE benchmark page? Shanghai Gold Exchange. Contract confirmation. Do you see strong closes? Volumes on AG. FX-aware conversion. When you run the conversion with a real USD, CNY rate, does the gap still exist? West refuses to break. Even as Shanghai is higher, does the West keep ratcheting upward instead of collapsing? Reuters' $75 print supports that the West is not soft. If you have 4 out of 5, this is real stress. If you have all 5, it's a structural warning. The 3 worlds of silver. This explains everything. Here's the mental model most people lack. Silver isn't one market. It's 3 overlapping worlds. World 1. Screen silver, spot quotes, futures, paper positioning. World 2. Deliverable silver. Bars that can actually be delivered through recognized mechanisms on a timeline. World 3. Movable silver. Deliverable bars that can be mobilized across borders and into the right buyer's hands fast enough to matter. When the market is calm, these worlds behave like one. When the market is tight, they separate. And when they separate, Shanghai often exposes it first because it's closer to real procurement. So the Shanghai premium is not just China bullish. It can be the market yelling, World 3 is thin. Why does Shanghai pay more? The common sense answer. Because someone in Shanghai is willing to pay more today. And that willingness usually comes from one of 2 motives. They must secure supply. Factories don't care about your thesis. They care about continuity. They fear future availability. They'd rather overpay now than miss production later. That's the difference between an investor and a procurement manager. An investor can wait. Procurement can't. And when procurement steps in, premiums become rational. Because the cost of not having silver can exceed the premium by a mile. What impossible to close means. Precision. When I say impossible to close, I don't mean nobody can do it. I mean, it can't be closed quickly enough, in enough size, without breaking something. You can close it for small size, maybe. You can close it slowly, maybe. But closing it fast, at scale, with certainty, that's where markets break. And you can see the conditions for breakage. West is already printing all-time highs near $75. Reuters. Shanghai conversion is still higher from published yuan KG series. Year-end conditions are thin and volatile. The gap is a symptom of system stress, not a random number. So the real signal is not the exact dollar amount. It's the stubbornness of the gap. 3 scenarios. No fantasy, just mechanics. Scenario A. The pipes reopen. Holiday ends, flows, normalize, the gap compresses. What you'll see? SHAG, AGT plus D. Converted price drifts down toward Western spot. Scenario B. West chases Shanghai. Shanghai stays strong. The West reprices up to match. What you'll see? Western spot pushes beyond the $75 milestone and holds higher levels. Reuters. Scenario C. Allocation world. Premiums persist, spreads widen and narrow, but don't fully close. Availability becomes conditional. What you'll see? More frequent dislocations. A market that behaves like who gets metal matters as much as what price is quoted. None of these require you to believe in a rumor. They only require you to watch the pipe, the how to track this daily section, practical value. If you want to stop being whiplashed by social media, do this. Every day, track 3 numbers. Western spot XAG, USD. SGE, SHAG yuan, KG, Shanghai Gold Exchange. SGE, AGT plus D, close yuan, KG, Shanghai Gold Exchange. Then track 1 conversion input, USD, CNY, daily, then compute. SHAG, USD, Oz, AGT plus D, USD, Oz. Compared to Western spot, your threshold triggers gap under $1, normal noise. Gap $1, $3, watch. Gap $3, $5, stress. Gap $5 plus. The pipe is screaming. And remember, the exact threshold isn't sacred. The trend is what matters. Here's the line that frames this whole episode. You don't have a silver crisis when price goes up. You have a silver crisis when availability becomes conditional. Shanghai trading higher than the West is one of the cleanest early signals of conditionality because it's not saying silver is pretty. It's saying deliverable now is worth more. Blunt. If someone tells you Shanghai premium doesn't matter, ask them one question. If it doesn't matter, why hasn't it disappeared? Markets erase free money fast, unless the money isn't free. Unless the real constraint isn't price, it's access. And today's numbers are not invented. They're published. SGE benchmark prints like SHAG 17140 on DEX 25, Shanghai Gold Exchange. SGE daily report shows AGT plus close 17414 on DEX 25, Shanghai Gold Exchange. Reuters confirms Western spot hitting $75.14. To screen 26, Reuters. FX around a $7.0059. CNY DEC 25 makes the conversion land around $76. $77. What would make me change my mind? Trust builder. If the gap collapses hard next week and stays collapsed, I'll call it what it is. Holiday distortion plus temporary tightness. But if the gap persists, especially after normal liquidity returns, then this is not a holiday story. It's a structural story. And that is where silver transitions from trade to secure. So here's what happened in one breath. Western spot just tagged $75 and printed a record high near $75.14. Shanghai's published yuan-KG series convert to roughly $76, $78, depending on which reference you use. That creates an ARB gap that should close. If it doesn't close, the market is telling you the marginal ounce is not freely movable. And when the marginal ounce isn't freely movable, the market starts behaving like allocation. That's the real story, not the price, the pipe.